Alright, so as you have found out, the beginning of my last video was an April Fool's joke. We are still doing these videos day after day. In fact, because of all the comments we got and all the thumbs up that we got on Monday's video, that video had the biggest reach of a lot of our videos that we've had here lately on YouTube. In other words, more people who don't subscribe to our site saw that video than we've seen in a long time because of all the engagement. So now you see why we ask you for the thumbs up video after video after video. It's an easy way to give us feedback, but it also is a great thing for us in pushing our content out there to the biggest audience possible, as well as for you, letting them know, YouTube, Twitter, Facebook, that you engage with our content, that you want them to keep pushing you all of the content that we put out there. So with that, let's go ahead and start with today's video. We're going to break down this move that we've had the last couple days that's continuing to push to the upside, what it means, and how we might be able to trade a stock that has been doing very well that we've looked at in a previous market outlook video, and what kind of trade we can do to take advantage of any potential weakness there. So let's go ahead and get started. Today is Wednesday, April the 3rd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, well, let's take a look at the S&P 500 with the Market Forecast Indicator. You can see first that we see that I got another really small range day today, about 20 points, well below the average. Yesterday our range was 14 points. Obviously we had a bigger range that day, before that 16, before that less than 21. Of course, that one includes the gap, right? So we're getting some really small days. You'll see some small volume as well. That hasn't kept the intermediate line from rising back into the upper reversal zone. In fact, you notice that the S&P, the Dow, because it just now got above 82 with that breakout move that we had a couple days ago, and the NASDAQ Composite all have intermediate lines. Now granted, they're all coming off of intermediate lows that correspond to higher lows. I mentioned that in the last video about that divergence there of lower lows in the intermediate line corresponding to higher lows. That's especially when you get that towards the that 3-month mark of an intermediate run, which this one started back here on January the 10th, the 11th, so we're a week away from being 3 months. That's this kind of doesn't mean that we have to go down immediately. We usually get another little push higher like we are right now, but you'll see the NASDAQ, how strong it's been. But look at continue to look at the Russell 2000, that unlike its peers is not above these highs or above its February highs, and of course is not anywhere close to its well, it would be October highs for the rest of these. See, the market peaked here for the rest of the indexes. That's not even close to its own high. It was already on a bearish move by the time we got that. Here is where the S&P is relative. In fact, if you look at this date right here, October the 9th, see, right as of the 9th, things look still pretty good. You got your 3 red arrows. You look like we're holding the low, setting the low point. It looks like we're going to hold that low, kind of meander around it, bounce off of it, and of course, October the 10th changed that. But barring that, going back to October the 9th, we closed that day at 28.80.34, and today we closed at 28.73.40, and we were trading today. The high point of today was at 28.85.25. So earlier today we were up above that high point. We're pretty much back to unchanged when we were still kind of at normal levels, right? October 10th changed everything. But before that, now it's kind of a normal intermediate pullback that we were getting, that we could have expected. But of course, 2 down days in a row, and we got a cluster, and then things changed dramatically there. So we've recovered a lot, but we have not recovered back to, again, October the 9th would be right here. And of course, we were far lower on the Russell, already breaking below all these lows. And you notice we are not back to the October 9th level. 1621 would be the equivalent for the Russell 2000. So continuing to show some outperformance. It's one thing for the Russell to show outperformance, but it's another thing for it not to confirm the breakouts that we're getting, whether it's above the most recent highs or the ones in February. And you can see again, it's also coming off a lower intermediate low point that happens to be slightly lower. But it's also, you got dark green shading, but the moving average is falling. So we're not back to a strong, to a bullish trend yet like we have on all the other indexes. So that is a little bit of a concern in terms of how we've been really bullish. So you see we've gone from this kind of curve upwards to now we're kind of curving sideways here. It's rare for us to go from this kind of curve where we're flattening out to then going back to an upward curve. Usually we flatten out all the way and get that intermediate pullback. So we'll kind of keep our eyes on that curve. It doesn't mean, again, that might take a while. It might take a few weeks for that to finally flatten out and for us to test it and turn red and yellow like we already have on the Russell 2000. See, like this is what you'd expect when you got that kind of an upward curve that flattens out. We're just not quite to that point yet on the, we're getting closer to it actually on the Dow than we are, say, on the S&P, because the S&P is largely influenced by the NASDAQ, which is not even close to flattening out yet. And of course it doesn't have to, because it's a little bit more of a higher beta. Alright, before we look at some of these other charts, a reminder, subscribe to our YouTube channel, mouse over our logo right here in the bottom right corner of your screen, then click that red subscribe button that pops out. There's also a red subscribe button down below the video on the desktop page there. Also, click that thumbs up icon that's down there. That tells us two things. Number one, that you got something out of our video today. Number two, that you want us to do the video again tomorrow. It's a great, easy way to give us feedback. You can do that right now while you're watching. Comment down below on anything that stood out to you from tonight's video. What did you get out of it? What do you think? Why do you think it would be beneficial for anyone else that's new to the video that they should watch it? So you can be able to put that down there in the comment section. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen up there. Click on that link to subscribe. Follow me on Twitter for more content in between videos from day to day, and join our daily market outlook. Join our market outlook community that we've created on Facebook. Remember here, if you're watching the blog, our video here on our blog, there's a lot of links here on this page. So make sure you scroll up and down. You can subscribe to our email list here too. Very easy way to do that. You can share these videos across any of these social platforms. Really easy button. You can see other blog posts that Brandon and I post over here on the right. There's our calendar of upcoming classes, a link to our Market Outlook forum so you can be able to chat with other market scholars in between the videos. Again, you can open up any new threads with questions or comments or reply to anybody else's threads. You have to subscribe to our site to do that, but you can do that for free by clicking on this image here, and it takes you to a new page where you can subscribe. And of course, we always look for 3 clicks here. Number 1, click on this heart. That opens up today's Market Outlook tweet. You can click on that like button. Also click on this image that takes you to today's Market Outlook Facebook post. You can like it and share with other people there as well. And then finally, this third click here on the like button on our blog on our website. Alright, now let's go back to the charts. Let's look at the long-term view of the charts, the weekly chart. You can see still we got 2 more days left in the week, and it's Friday is employment number week. But so far, closing up above the high of that long upper shadow. Very, very good sign, showing a good bullish candle on the Hakinyashi candlestick there. So a bullish pattern, rising 50-day moving average, rising 200-day moving average. Again, doesn't look that way across all these things. We're not above that upper shadow there on the Russell. We don't have the golden cross yet on the Russell. And then you look at the Dow Jones, very similar. It's unlike, like, say, the NASDAQ, which is really breaking out, also getting above that long upper shadow. The Dow's not quite, right? Since, again, not close to these other highs here. Let's take a look at the 3 green arrow chart for the S&P 500. Obviously, we're getting 3 green arrows. Like I said, the line's flattening. It's not flattened as much as it has, say, for the Dow. And then, of course, the Russell's already flattened. So that's the kind of pattern on the moving average that we expect to see with some lots of arrows, up and down arrows here. We are getting 3 green arrows even on the Russell 2000 too. When you look at the 2-line version of the SPX, we are back to being well up above the 30-day moving average. In fact, this is the 8/17 day. It looks like, again, it's we tend to peak early on this when we first get the initial surge, and then we kind of meander down with lower highs. So you can kind of see we're getting to the point where we're kind of peaking here at what would be so far a lower high point than the last peak on the MACD, even though we're already higher here. Same thing on the stochastics. If you look at the RSI, and the DMI or CCI. The CCI got strongly overbought here on this last run. The CCI got overbought on this run here, or the RSI, excuse me, and it's forming also a divergence. So lots of bearish divergences across multiple oscillators here. You look at the DMI for SPX, and the same thing. Lower highs on the DI positive with higher highs here. Lower lows on the negative. That's expected because we're getting the higher highs, but not on the blue line. So again, another divergence. So we're getting lots of oscillator divergences here across all these different indicators. Let's take a look at the intraday moves, and you can see we did get a higher high and a higher low, so that's a positive sign. We did not close at the high of the day, though. We came down. Actually, we're testing yesterday's high point on the way down. So not the most bullish close, but a bullish candle nonetheless, and getting a new 4-week high point, which is a very strong sign. As I mentioned before, getting to a 5% gap, but that's going to shrink really quickly because this is going to move up very quickly up to these lows. So we're going to make up about 5 points of difference here and have about a 10-point gap unless we push really high to the upside, because you see how in 3 days this will come off, then we'll move up to that low point right there, and then and that's in 4 days, and then 5 days we'll be there, and we'll be there for a while until we retest. So that means the dotted line will also move up probably around to that last week's high point right in this area, and of course the Hakinashi Open will be in that area too. So we'll still be in the upper half of what would be a much smaller range because we'll move up that quickly. And again, as I mentioned before, the trading range today was below average. Well, 2 points, well below 1% too. The ATR is below 1%, and the volume is at 68 million. That was also a smaller number. So that volume's coming back down again. The trading range is coming back down again. They don't have much lower to go, but they are at least we're not. We don't have these big bearish moves, these bigger days. We're really slowing down, and that's a bullish sign when you have these small days and small volumes. You take a look at volatility. It's interesting. Volatility has been unable to get to a new lower low point. Remember, the S&P is up to a higher high compared to that peak that we had that corresponds to this VIX low point. But you notice we did not get to a lower low. In fact, we're kind of forming a higher low, and we are bouncing up today. So volatility is actually rising for most of the day during this kind of intraday pullback. We're not breaking into a neutral zone. We're still kind of in this bearish territory. But you notice, while we have broken below 90%, we still haven't broken into this lower half of the chart where we kind of go up and down through here. So keep that in mind. And last time we approached this area, we did break through to the upper half. So we'll see, if that kind of follows here on any kind of short-term weakness that we may get, considering the divergences that are occurring and how far up above that 30-day moving average we are, considering the flattening of that moving average, similar to what we already see on the Russell 2000 and what is coming up on the Dow Jones Industrial Average, the flattening that we see there. So to summarize, our posture remains bullish, strongly bullish, but it is maturing, not to the point where we can't make any bullish trades, because you just don't know. We saw last year that we had a 3-month intermediate posture that, instead of weakening as expected according to the time frame, we got a 4th month and then a big old 5th month of volatility. That was in actually January of 2018 that then precipitated this big decline February of 18. So we can go a lot further, and after the election, presidential election in late 2016, that started an intermediate rally that went an extra month there. So even though we are at 3 months in and showing signs of maturing, that eventually we'll get that flattening out and that intermediate pullback like we've seen before, we can break. Like a China trade deal might get us that extra 4th month, right, or 5th, or even 5th month, like we saw with the tax reform at the end of 2017 into 18. So we don't want to not be bullish, but just know that the signs are there of that impending intermediate pullback that may occur, that we've been looking for a while, and that we just continue to grind our way to the upside with headlines that we just saw here, that I just saw, that China is going to meet with, or Trump is going to meet with the China vice premier at the White House later this week. So, stuff like that, headlines like that has been very bullish for the markets, despite weakening, like we'll see here in a minute, weakening indicators or weakening earnings growth, or even that yield curve, that falling yield curve, which hasn't inverted yet, but that falling yield curve. So, and rising interest rate cut odds. So that being said, that's the outlook for today. What do you think about that? Do you agree or disagree? There's a link popping out in the top right corner of your screen up there. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, scroll down to the bottom where you can comment on what you're seeing that would suggest otherwise. Maybe you think we already had that pullback and we're still got plenty of room to move to the upside. Maybe you think that we should be a lot more bearish than just expecting a pullback, that we are probably going to re-enter a bear market. Whatever the disagreement is, scroll down and comment there what you're seeing that would suggest that that's your outlook. All right, now let's transition to what's driving the price action today. Emerging markets really had a nice, good rally to start the day. In fact, they finished the day strongly, despite a little pullback towards the end. Of course, developed markets also up there, all outpacing the S&P. In fact, the S&P also started strong, lagging behind small caps, but this weakness in crude oil brought this down. In fact, if you take a look at USO here, take a look at the the ETF for crude oil, you can see how flat it was. Now you had a big build in inventories. There's the actual crude oil futures contract. We actually had a big build in inventories, and that caused some of the weakness. Remember, this has been one of the drivers for equity. This equity rally is this nice, good increase in crude oil, and there's no flattening there yet either. We're not anywhere close to that flattening out, like we are, say, on the Russell 2000. So keep that in mind. But that's been a big driver for a lot of this rally that we've had. Here, let's go back to the asset class, and of course you can go all the way back to December the 24th, to where the low point occurred, up till now, and you see crude oil has been the biggest winner by far, up over 35%. During this increase, whereas the S&P 500 and the Russell are sitting right around 20% gains, and then there's your international stocks all lagging behind, while the dollar the dollar's been relatively flat, a little bit of an increase here at the end, but relatively flat. And gold, which had also started off strongly with that decrease in the dollar, gold is pulled back to where it's only up 2% now, kind of matching what we're seeing from long-term bonds, which have had a recent rally here with that big drop in yields that we saw here recently. So nice, good. This is a pretty decent 3-month rally that we've had, and risk appetite to the point where your 3-month returns on your S&P 500 are at relatively high levels, nearly 15%. Pretty strong number there. But you can see the 6-month return would suggest that even if we do get any kind of pullback like we're seeing on the Russell, we still got plenty of room to run for that number to start to increase. If we take a look at the calendar, we had a few things come out today. The ADP report came in below expectations at 129,000 compared to a consensus estimate of 165. In fact, below the range of estimates there. If you take a look at the services ISM, so not the manufacturing but the services, you can see that also came in below the consensus range of estimates and well below the previous number. So we're continuing to see this drop in economic indicators relative from the actuals being lower than what we're seeing in the estimates. And pretty much a rollover in all these indicators, especially on a year-over-year basis, as we saw yesterday with the durable goods orders and their year-over-year figure dropping down, continuing to drop down and getting almost to negative levels. So you see a common trend since last August these steady declines in indicators, and you see that reflected in just persistently lower than estimated numbers, not just here but also globally too. So not the best environment for risk appetite, but we were still able to flourish because of sentiment, right? Because of positive investor sentiment, looking forward towards some kind of deal, potential deal, trade deal that can, that's why I think the market, well, at least what I believe the market's trying to price in here. Take a look at how the foreign markets have performed. Emerging markets, remember, did well. There is South Korea. You can see Indonesia, but also these developed markets also did very well too by the end of the day. Germany, Italy, France, all rising. There is China outpacing U.S. equities too, and there's the global index here that we usually benchmark ourselves to. So it was a good day abroad for equities. And they've got some underperformance that they can unravel a little bit here relative to U.S. stocks, especially if there is any kind of weakness in the dollar index. I mean, take a look at that dollar index, and we're still, I mean, it continues to kind of peak around this 97 to 98 level, and we're unable to get through a 98 any of these times. From a sector perspective, interesting to see that energy, which has been such a big winner as with crude oil, has pulled back today. You also see staples, you see utilities and real estate all down on the day. So kind of a down day for safe haven stocks, but a continuing good day for these cyclical stocks. They didn't finish at those levels, but you see how they started really well, especially with materials also looking like a good performer. Those are really all the ones that outpaced the markets, and materials actually held up. They've been a weaker sector, so a little bit of a bounce up for them. Everything else kind of lagging. Financial still lagging, and industrials also, and they've had some relative strength here in the last little bit, but they're lagging too today. So this kind of shows again these FANG stocks that are representative of these particular sectors are the leaders of this little rally, and they continue to be the leaders of this rally. And you can see going all the way back to that December 24th time frame right there, and go to a daily chart. You can see, there's your technology up almost 30%, and discretionary and communication services. Those are the three sectors that have outpaced the broad market during that same period of time, along with industrials. Here, industrials was so strong before that Boeing pullback, and now it's starting to regain some of that strength. All right, for our trade example of the day, back on February the 15th, we looked at buying opportunity here, right in this area of Nvidia. And look at it, had 3 green arrows. It was on a bullish trend. Stock was trading at 157 and a third at the time, and now it's obviously up to 188.62. And like other indicators, showing signs of divergence as well. The intermediate line lower highs, and you can take a look at like its MACD and stochastic indicators here for Nvidia. Potentially forming lower highs on both the MACD and the stochastic. So there might be a period of softness here. You take a look at its Bollinger bandwidth. It is relatively high. I mean, not extreme, but when you take out the extremes, when it's just kind of normally trading, this is about the level it gets to. You can see it's been trying to break out, and it's kind of in this volume vacuum here. But you also have filled in this gap. We've come and we filled in this gap that we broke down on that earnings. So we've got a little bit of a resistance level from a price standpoint, even if not from a volume standpoint, with a little bit of movement to run up towards this 200 area. You take a look also at other oscillators like the CCI and the RSI. You can see they're also forming the same divergences on those, and at pretty darn high levels as well. So it's not like Nvidia's in any danger of like showing us 3 red arrows. In fact, the last time it showed 3 red arrows, like we talked about in the video in February, that ended up being a bounce, and we just moved our stop order up, and you move up higher, right? So we, it doesn't look like we're not in any danger of a 3 red arrow signal here, But considering how overbought we are, there's opportunity that we can sell a covered call on that at 205. That gives us plenty of room to work with. It only lowers our cost basis by another $4.85. So that would get us down to about what, $1, 150, about 152 ish. If you take out that $5 there. So, and if the stock does rally and we do close it above 205 at expiration, especially with earnings right before expiration, to sell it at 205 in 3 months after having bought it at 157 with that well, actually at 152 with the cost basis lowered by the covered call. That's not bad to get a $50, kind of a 30% return in a matter of just a few weeks. So I'm willing to put in a sell limit order essentially at 205 and get paid to do that right around that option, or excuse me, the earnings announcement that's coming up. In fact, it's like the day before this option expires. Alright, so that does this for today. Now I want to hear from you. Use that link popping out in the top right corner up there that goes to our Market Outlook forum. Remember, you have to subscribe to our site, but you can open any new threads there, reply to anybody else's threads, on any questions or comments you have on what we discussed in the video or anything we didn't discuss in the video. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon and comment. Also remember to follow us on Twitter for more content in between videos, and join our community on Facebook as well as at marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all next time.